Hey everyone, welcome back to Corporate Decoder, the place where we peek behind the curtain of corporate filings to see what is really going on. Today, we are diving into a report from Northern Lights Fund Trust, specifically looking at the Princeton Premium Fund. So buckle up because we are about to decode some serious financial information. And let me tell you, there are some interesting numbers in here. Before we dive too deep, if you enjoy getting straight answers from these dense filings, make sure you hit that subscribe button. And hey, we have an awesome community over on Discord, linked right in the description below, where we can break down these reports together. Alright, so this document is called a Form N-CSR, which is basically a certified shareholder report for investment companies. Think of it as a yearly checkup for a mutual fund, telling shareholders exactly how their money has been managed and how the fund has performed. We are looking at the Princeton Premium Fund, which has a couple of different share classes. Today, we will focus on Class A shares, ticker PPFAX, and also briefly touch on Class I shares, PPFIX, as they share a lot of their core performance. Let us start with what it costs to invest. For a hypothetical $10,000 investment in Class A shares, the costs for the last year come out to $226. That is about 2.20% of the investment. Not too bad, considering what we will see later. Now, for the big question, how did this fund perform for the fiscal year ending the 30th of September 2025? The Princeton Premium Fund returned a solid 5.49%. That is not bad at all. What is this fund trying to do? It aims for growth and income by selling put options on the S&P 500 index. Think of it as collecting a small fee called a premium, each week by making a bet that the index will not drop below a certain level. They also invest in fixed income securities, which are generally safer bets like government bonds. The report tells us their option trading strategy was profitable in 11 out of 12 months. That is pretty consistent. The 1 month it struggled was December 2024, a period that saw quite a bit of market choppiness. Apparently, a big Federal Reserve announcement then caused a spike in the VIX index, which measures market fear, from 15.87 to 27.62 practically overnight. In that environment, the fund had to close some trades at a loss, what they call educated losses, to manage risk on the flip side. Their investments in fixed income, mainly treasury bills, performed well and helped offset some of those option trading hiccups. Let us look at the long-term picture. This table shows how a $10,000 investment has grown since November 2016. It is fascinating to see the contrast for the Princeton Premium Fund that $10,000 has grown to $14,597 by September 2025. That is a decent increase over nearly a decade. However, compare that to the S&P 500 index where the same $10,000 would have ballooned to a much larger $35,725 by September 2025. This is a key insight. While the Princeton Fund has grown, it has significantly lagged behind the broader market, the S&P 500, which represents many of the largest US companies. This tells us that while the fund generated positive returns, its strategy did not keep pace with simply investing in the stock market itself. Looking at average annual returns, the Princeton Premium Fund, without loads, offers 5.49% for 1 year, 6.95% for 5 years, and 5.05% since its inception in November 2016. For Class I shares, which have different costs, the returns are slightly higher, 5.72% for 1 year. But again, the S&P 500 index trounces these numbers with 17.60% for 1 year, 16.47% for 5 years, and 15.43% since inception. This reinforces that the fund's strategy, while profitable, is not designed to capture the same kind of upside as the market. It is more about collecting premiums and managing risk, which typically means sacrificing some of the high return potential of the market. Always remember, past performance is not a guarantee of future results. The fund has total net assets of about $300 million. That is a pretty significant amount of money being managed. Interestingly, the number of portfolio holdings is very low, just 13. This aligns with their strategy of focusing on a few key areas. The advisory fee, which is what the money managers get paid, is a little over $5.4 million. This is a substantial amount, and it is important to see if these fees are justified by the performance. And here is a big one: portfolio turnover is 0%. This means the fund managers are not actively buying and selling a lot of securities. This makes sense given their strategy of holding treasury bills and employing an options strategy that does not involve frequent trading of the underlying assets. When we look at where the money is invested, it is heavily concentrated. About 87.7% is in US government and agencies, and 12.3% is in money market funds. Drilling down further, 89.1% is in US Treasury obligations and 12.5% in money market funds. This means the fund is almost entirely invested in very safe, short-term US government debt. The top 10 holdings are all US Treasury bills with various maturity dates in 2025. The largest single holding is a Treasury bill maturing on the 4th of November, 2025, making up 8.6% of the net assets. This confirms the fund's conservative approach, prioritizing capital preservation and steady income from interest payments. The report also states that there were no material changes during the year. This suggests a stable, consistent strategy. Now, the Class A shares have slightly lower costs, about $201 for a $10,000 investment, or 1.95%. Their performance for the year was 5.72%, a bit higher than Class A, which is expected with lower fees. Interestingly, the table for Class A shares shows a $100,000 investment. By September 2025, it grew to $158,428. Again, this is good growth, but still significantly less than the S&P 500 index, which would have made $357,254 from the same initial investment. Let us look at the actual investments. You can see here the breakdown of their holdings. We have a large portion in US Treasury bills. For example, $25 million worth of Treasury bills with a yield of 4.2050% maturing on the 7th of October, 2025, valued at just under $25 million. They are all very similar, with varying yields and maturity dates. And then we have the Dreyfus Government Cash Management Fund, a money market fund with a yield of 4.12%. This all reinforces the extremely conservative nature of the fund's portfolio. Moving over to the statement of assets and liabilities, we see the fund's total assets are around $325 million. Liabilities, mostly for securities purchased and payable for fund shares redeemed, are about $24.8 million, leading to those net assets of $300 million we saw earlier. Paid in capital is about $297 million. That is the money shareholders have put into the fund. Accumulated earnings are around $2.9 million. For Class A shares, the net asset value per S-share is $11.87. The maximum offering price, which includes the sales charge, is $12.59. Class A shares have a net asset value of $12.04. The statement of operations shows how the fund made and spent money over the year. Investment income, primarily interest, was over $13.8 million. Total expenses before fee waivers were about $6.6 million. This includes investment advisory fees and various administrative, accounting, and legal costs. Crucially, the advisor waived over $270,000 in fees. This means the actual expenses borne by the fund were lower, saving shareholders money. This results in a net investment income of about $7.5 million. Then we have realized and unrealized gains and losses. The fund had a net realized gain from investments and options written of over $11 million. However, there was a net change in unrealized appreciation and depreciation, resulting in a net loss of about $318,000. Overall, the net increase in net assets from operations for the year was over $18 million. The statements of changes in net assets show how the fund's net assets changed over time. For the year ending the 30th of September 2025, net assets increased by about $18.3 million from operations. Shareholders received distributions totaling nearly $14.7 million in 2025, down from over $22.5 million in 2024. Shareholders also bought and sold shares. They bought about $113 million in Class I shares and redeemed over $186 million in Class I shares. This indicates a net outflow of money from Class I shares during the year. The total change in net assets for the year was a decrease of about $75.6 million. This significant decrease is mainly due to the large redemptions of shares, outweighing the gains from the fund's operations. The financial highlights provide a more detailed per-share look. For Class A shares, we see the net asset value at the beginning of the year was $11.69, and it ended the year at $11.87. The total return for Class A shares was 5.49%. Remember, this is without considering taxes. The ratio of net expenses to average net assets for Class A shares is 2.20%. For Class I shares, it is 1.95%. These figures are important because they represent the ongoing cost of owning the fund. Now we get to the notes to financial statements. This is where the really important details and explanations are. The Princeton Premium Fund is part of the Northern Lights Fund Trust organized in Delaware. It started operations back in November 2016. The fund is non-diversified, which means it can invest a larger chunk of its assets in a limited number of securities. This can amplify both gains and losses. Here they explain how they do their accounting. They mainly follow generally accepted accounting principles in the United States. They also mention they operate as a single operating segment, meaning all their activities are viewed and managed as one unit. This is pretty standard for investment funds. They explain how they value their investments. Most are valued at market prices. For less liquid or hard to value assets, they have a fair value procedure approved by the board, with the advisor acting as the valuation designee. This section details how they handle options. They are selling put options on the S&P 500, kind of a spread strategy where they buy and sell options at different strike prices. The goal is to collect premium while limiting risk. They mention that if options expire worthless, the fund keeps the premium. This confirms their strategy aims for consistent, smaller gains, rather than large market swings. This part explains how their use of options, which are derivatives, shows up in their financial statements. Essentially, it breaks down how the gains and losses from these option trades are reported. Looking at the fair value of their assets, we see the US Treasury bills are valued at over $267 million, and the money market fund is about $37 million. So their reported net assets of $300 million are almost entirely made up of these safe, interest-bearing investments. This section is about their relationship with the investment advisor, Princeton Fund Advisors, LLC. They charge an annual advisory fee of 1.75% of the fund's average net assets. That is a significant fee, especially when you consider we saw the fund's performance lag the S&P 500. However, they also mention a waiver agreement. The advisor is waiving a portion of its fees to limit the total expenses to 2.20% for Class A and 1.95% for Class I shares. This is good for shareholders as it caps their costs. The advisor may seek reimbursement for these waived fees for up to 3 years. Here they detail the distributions paid to shareholders. In 2025, ordinary income distributions were about $11.8 million, and long-term capital gains were about $2.8 million. The tax basis for accumulated earnings shows a positive balance. This is a good sign, indicating the fund has managed its income and gains effectively from a tax perspective. This is the auditor's report. RSM US LLP states that in their opinion, the financial statements present fairly the fund's financial position, results of operations, and changes in net assets. This is a standard clean audit opinion. They also mention they have audited investment companies advised by Princeton Fund Advisors since 2010, showing a long-standing relationship. This section is quite interesting. It details the Board of Trustees review and reapproval of the investment advisory agreement with Princeton Fund Advisors. They discuss the nature, extent, and quality of services provided by PFA. They noted PFA's focus on liquid alternative strategies and risk management. They also mentioned an SEC deficiency letter from September 2024 related to a private fund, but importantly, it was unrelated to these mutual funds. Under performance, the trustees noted that Princeton Premium has about $312 million in assets under management, a decrease from the prior year. They also mentioned a 3-star rating from Morningstar and PFA's goal of achieving 7 to 10% total returns per year. Since PFA took over as advisor, the fund has achieved an 8.39% annual return over the last 5 years. However, they also acknowledged the fund's 1-year yield was 2.12% with a low standard deviation. Regarding fees, the trustees noted the advisory fee of 1.75% for the fund, which they found was in the 85th percentile, meaning it is higher than most peers. PFA's reason for this higher fee is the uniqueness of its strategy and the experience of its team. The trustees concluded that the fee was not unreasonable. Ultimately, the trustees concluded that approving the continuation of the advisory agreement was in the best interests of the fund's shareholders. Now, let's talk about what all of this means. The Princeton Premium Fund strategy is clearly focused on capital preservation and generating consistent income through premium collection from options. They are heavily invested in ultra-safe US Treasury bills, which is why their portfolio turnover is 0 and their returns are stable but not spectacular. The main takeaway here is the trade-off. The fund offers stability and income, but it significantly underperforms broad market indexes like the S&P 500. Their strategy is designed to mitigate downside risk and avoid large losses, which it seems to do reasonably well. However, this comes at the cost of missing out on the big upswings that the market can offer. The fact that shareholders redeemed nearly $76 million from Class I shares in the last year, despite positive returns and advisor fee waivers, suggests that investors might be looking for higher growth potential elsewhere, perhaps in funds that more closely track the S&P 500. So, is this fund right for you? If you are prioritizing capital preservation and steady income over aggressive growth, and you are comfortable with potentially lower returns compared to the broader market, then possibly. But if you are looking for your investment to grow at the pace of the S&P 500, there might be better options out there. Alright, that is our deep dive into the Princeton Premium Fund's latest filing. What are your thoughts on this conservative strategy and its performance compared to the market? Do you think the fee structure is justified? Let us know in the comments below. If you found this analysis helpful, please give it a thumbs up. And don't forget to subscribe for more corporate breakdowns. And again, join us on Discord. The link is in the description. Thanks for watching, and we will see you in the next one.